Hello, everybody. Welcome to Know Your Money. I'm Bronwyn Weiner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast.
Hi, everybody. Today, Amika is back with us, and she's from Coronation. She'll introduce herself. We had a question from one of our clients to say, how should they plan for retirement, post-retirement? And we thought a great topic that you can cover today is what are the risks that they should factor into the part of their post-retirement planning. Welcome, Amika.
Thank you. Thanks, Bronwyn. My name is Amika Gordhan, and I'm an investment specialist with Coronation Fund Managers. I've been with the business for almost 12 years, a long period of time. And one of the things we are very passionate about is making sure that clients have good outcomes from their investment portfolios, particularly so that they can retire comfortably one day. But, returns are sort of one side of the equation. You've also got to manage risks on the other side of the equation. I think particularly in the post-retirement space, so once clients are retired, there's three key risks that we think they should be acutely aware of. And being aware of those will guide them in terms of making good decisions on how they put their post-retirement portfolios together. So the first risk is inflation risk. So simply put, this is the risk that your investment portfolio, once you get to retirement age, doesn't grow ahead of inflation. So remember, inflation is just the rise in prices from year to year. But if your portfolio doesn't keep pace with inflation, what happens is you lose what's called purchasing power. Now, purchasing power, very simply, is how much of goods and services you can buy with 1 unit of currency. So if I had 1 rand worth of assets, how much of goods and services I can buy with that. What inflation does is it erodes that over long periods of time. So to give you a great example numerically, if we assume that inflation is going to be 6% over the next 30 years, if I had 1 rand today, that 1 rand in 30 years' time could only buy 17 cents worth of goods. Now, that is what inflation does.
So, for example, 100 rand can get you a milk, a bread, and this, and in 30 years' time, it can't even get you the milk. Is that what you're kind of saying?
Exactly.
Okay.
So that is called erosion of purchasing power, where your money can no longer buy you the same amount of goods and services because prices have gone up. The way you try to protect against that is to invest your money wisely and make sure that the return that you get is ahead of inflation. That means that your money is growing in what we call real terms. Mm-hmm. So there's no point investing money and it grows at 5%, but inflation is at 7% because you still have the same problem where you can no longer buy the same amount of goods and services. So inflation risk is probably one of the biggest risks that investors face, whether it's a retirement portfolio or a discretionary portfolio, but particularly for retirees who mostly get to retirement age, they don't have another source of income. The money they've got is all they have. They have to live off that capital for a long period of time. If that money doesn't grow ahead of inflation, they have this problem of reduced or diminished purchasing power.
But high inflation has wiped out countries.
It wiped out Germany. Very dangerous.
In World War II, it wiped out
phenomenon.
Zimbabwe. Yeah. Just inflation.
I think it's coined the silent killer.
Completely.
In the short term, you don't really see the effects. It's usually over long periods of time that you see the impact of inflation compounded year in and year out.
And I think
it's kind of like what Warren was talking about when he said like the price of electricity or water going up.
12%, yeah, exactly. But that's where our monetary policy in our country has been incredible, how they've kept inflation under control. I think they've done a great job in that, against all odds.
Yeah, so we've had very subdued inflation in South Africa, but I think the risk is making assumptions about what inflation will be in the future, anchoring off what it has been in the past. And I think that's relevant for when you think about guaranteed annuities, so life annuities, where you make this investment into a life annuity that will pay you an income for life. And the inflation risk there is you escalate your income by, call it 5%, which is the most popular.
Most popular at the moment,
the most popular way to do it. And what happens if inflation is 8% or 10%, or we have runaway inflation? You still no longer able to keep pace with your cost of living.
So basically, in money terms, let's say you give 3 million rand and to the life annuity, and they say they're going to pay you 5,000 rand a month. You've given that 3 million rand, it's no longer yours, you have that 5,000 rand. That 5,000 rand will go up by 5%, but the value of that 1 rand won't necessarily be 5 because it's 8, so you'll be losing what you can buy.
Absolutely. So you get your 5% growth in your income every year, so you think you're getting more income. But if your cost of living is going up by more than 5%, you're actually poorer off because the money that you're getting can no longer fund, goods and services you need to purchase in retirement.
And our model portfolios, we've got benchmarks to beat inflation plus 5% or whatever it is over the period of time. And that's what we look at all the time to make sure that's happening. And even if inflation in the 80s, I know none of you were probably born in the 80s, but in that period of time, it was around 20%. So then the funds were doing 25, 28%, which is amazing returns, but they were beating inflation at the time. Now the funds are doing 12%, for example. It's still beating inflation by a long way, but still it's not 28%. But you're still in a positive territory because you're beating inflation.
Yes.
That's your point.
That's exactly the point. And one of the ways to try and mitigate against inflation risk is to make sure when you put your portfolio together that you have the right mix of asset classes. So we talked about asset classes being equities, bonds, property, cash, local, offshore. You have a well-constructed portfolio that has got enough exposure to what we call growth assets, right?
Okay.
Now, growth assets, by definition for us, are equities, property, and commodities, excluding gold. And these are the assets that give you the best chance over long periods of time of beating inflation. So if you look at any measure of performance of equities versus cash versus bonds over long periods of time, the best asset class to beat inflation and preserve that purchasing power over long periods of time has been equities.
And equities are, in our terms, is you buy shares in MTN or Standard Bank.
Yes.
And the Standard Bank,
shares, yes.
The Standard Bank share goes up because their client base is getting bigger and bigger. They make more money, and that money goes back to our investors who, in one of your portfolios, owned a little bit of Standard Bank. Is that right?
Yes.
And sorry, why excluding gold?
So gold is a more defensive asset. We classify it as a more conservative defensive asset as opposed to a growth asset. Yeah.
What would be other examples of commodities then that you?
So you can buy platinum, oil, rhodium, any of the metals. So those are all commodities. Coal, those are all commodities that you can have exposure to.
Why is gold seen as defensive then?
It's termed a safe haven asset. So people buy gold when they're worried about the state of the economy. It's got a store of value.
Yes. It's almost a confidence thing as well, because there's not enough gold in the world.
There's a finite amount of gold in the world
to cover what the value of gold is, kind of thing. So, but people think I'd rather have a gold coin in my pocket than a US dollar in my pocket, and that's where they go back to gold.
Yeah, so we classify gold as a more defensive asset, so we exclude it from the growth asset. When constructing portfolios in the post-retirement space, we suggest that investors make sure they have a healthy exposure to those growth assets.
Because it's quite tempting to go into cash. And especially when cash does well. You go, I can get cash. But then cash is not going to outperform, as you said, equity. So
cash does not have
short-term gain, not long-term.
Absolutely. Over long periods of time.
No volatility, which is attractive, but you're going to get hurt later on.
Because it doesn't deliver inflation-beating returns year in and year out over multiples of decades.
And there is loads of research on that. It's not like just some guess that people are saying it's true.
50 years of it, at least.
Yeah, we've got stats that show 100 years worth of data. And the value of 1 rand in cash is still 1 rand in cash, 100 years later. Whereas if you look at equities, it's hundreds of times what, it's worth. So the best asset class to deliver those inflation-beating returns over long periods of time is equity. So we suggest you have an appropriate amount of that asset class.
So, for example, in your living annuity, you should have X amount of equities in your portfolio.
Yeah.
And hopefully those equities will always outperform inflation. So no matter what inflation does, you're going to get a better than inflation.
So over long periods of time,
sure,
yes.
Absolutely.
Remember, equities have volatility. So in the short term, prices move up and down. So you're not guaranteed to get that inflation-beating return. But over extended periods of time, your best chance at beating inflation is to have equities in your portfolio.
But that's why you have a basket of asset classes, because a portion of it will be in cash and a portion of it will be in equity, so that it's diversified and it can work out.
Yes.
Okay, so that was risk number one.
The other pillar.
The second risk is longevity risk. And here
what do you mean by longevity?
So here we're talking about
how long you're
going to live for, how long are you going to be in retirement for. So most people, when they get to retirement, sort of plan for maybe 20 to 30 years. We suggest planning for 30 years because people are living longer. Medical advances, people are looking after themselves, people are living longer than they were decades ago. So plan for a longer retirement. In order to sustain a longer retirement, here too, you've got to make sure that your mix of assets is appropriate and you also have a decent exposure to growth assets to keep that capital growing over long periods of time. So it's making sure your time horizon is appropriate. There's no point planning for a 15-year retirement and then you live for 30 years and then you haven't adequately catered for how long you're going to live for, right? So if you err on the side of caution and plan for a 30-year retirement, we think that's more appropriate. Linked to that is how much of income you draw from your living annuity to sustain that 30-year period. And here again, there's been lots of research done about what optimal levels of income are. And our research suggests that around 5% initial drawdown is sufficient to sustain a 30-year retirement.
So that won't run out. In other words, if you draw 5%, whatever that is, your capital...
It'll take you 30 years before you hit your 17.5% cap, after which your capital starts.
Warren, I don't know if you remember that 4% rule that we said.
Roughly.
So if you take, let's say you want 10,000 Rand in retirement, you times that by 300, that would give you 3 million. From that 3 million Rand, you only want to draw 4%, or Amika's saying 5%. And if you drew 4% of 3 million, it would give you 10,000 Rand a month. That 3 million Rand will be able to then grow. So if this year it was 8%, you'd have a little bit more than 3 million, but you're drawing the right amount down so that it lasts for 30 years. If you drew out the full interest, so the full 8%, it's back to that 1 Rand or 100 Rand can only buy you milk and bread and would only buy you half the milk, because your money is not worth what you need. So it's about that.
I have a question relating to that from a bit earlier, actually. So you were saying, you said roughly 12% maybe is what a fund manager will return on your investment annually.
It depends on the period. I'm just saying the last...
Just argumentatively.
On the last year,
yeah. Let's call it 12%, right? What was inflation last year then?
Well, officially, it's 3.5%.
3.5%. Okay, so your real gain is not 12%, it's the difference.
Yes.
Right, so...
If you can get inflation plus 2 over a 30-year period, you've done well.
Inflation plus 2?
In any environment of inflation plus 2.
Okay.
So it's real return over 30 years, you've done very well.
Okay, so what would... I know this sounds obscure.
Put a number
what's your
to it.
compound of that inflation plus 2 over 30 years?
Oh, would
As
have
a
to
guesstimate.
No, we'd have to do the numbers. But so it's a real return over the period. That's the important side of it. So you're going to have periods of time now. At the moment, we're in a low inflation environment, but we've been in the 20s, as I mentioned previously, and then the funds were doing 20 plus.
Why can't they carry on doing 20 plus? They can do it then. Why can't
because
they carry on?
the companies aren't making those
same amounts of
profits because the environment
of the inflation as well. So just back to that thing, if you said it was 12% and then it was 3, let's just say 12 and 3, you've got 9%. It doesn't mean you must draw on that 9%, because this year it's 12 and 3. in 10 years' time, it might be 20 and 2. Do you know what I mean? Or 20 and 25. So inflation's 20 and 25.
Yeah,
so that's why that fall.
I was just trying to define what the actual real value is rather than saying you're getting a 12% return.
Yeah.
Not
so the real value is the difference between where inflation.
So
but that's why
purchasing
real returns are so important because we're trying to consistently beat inflation. But the nature of financial markets is that you don't always get those smooth, real returns every single year. We call it the lumpy nature of market returns because some years you'll get 20%, some years you'll get negative 2%. But that's why focusing on the long term and staying invested because it averages out. Yeah. Exactly.
But that's your third point, right? Is if the share prices go down and you're in retirement drawing.
Yeah, which we'll get to what we call sequence of returns risk. Yeah. So to sum it up, the way to manage longevity risk is twofold, making sure you've appropriately planned for a longer time horizon and constructing your portfolio to make sure you have enough growth assets and that you have realistic assumptions around what returns are going to be and you have an appropriate starting income drawdown.
And save early for the longer period.
What about that island in Japan where they live to like 110?
There you go.
What are they doing there?
And most people assume that their retirement period will be shorter than it actually is.
No, you must always overestimate, surely.
Yeah, they do. Yeah.
So the third risk that we think is important to understand, especially for retirees, is what we call sequence of returns risk. Now, it sounds a little complicated, but all it talks about is the order in which you achieve your returns once you're in retirement. So no one has a crystal ball. We never know what financial markets, equity markets in particular, are going to do in a given year. And if your retirement coincides with an adverse market period.
So you retire the day
the year
that COVID.
Exactly. Yes. So if you retired at the beginning of COVID, or you retired at the beginning of 2022, which was another crisis, or you retired at the beginning of 2008 when the
or
GFC
87
hit.
Or 98.
So if your retirement coincides with an adverse market environment where equity markets are falling, it can severely affect your retirement capital and how quickly you run out of money, right? The problem is this is completely unknown. So you could get lucky and you could enjoy the first few years of great returns and then get the adverse returns, in which case you're better off. But if you're in the unfortunate cohort who happens to retire during a period where there's negative returns, like I said, it can severely deplete your capital over time. Right? Now, there's no sure way to avoid that because, like I said, you cannot predict what financial markets are going to do. But one way to try and mitigate some of that capital erosion is to invest in a portfolio that will experience lower volatility and have some element of capital protection. So the first two risks we talked about, inflation and longevity, we were focusing on making sure you have enough growth assets. To cater for this risk, we're saying make sure you don't have too much exposure to growth assets, particularly equity markets, and make sure you're in a portfolio that manages volatility, because the research has shown that if you're in a portfolio that manages volatility better and has some element of capital protection, even if you go through those negative market periods in the first few years, you will still come out better than had you been exposed to a portfolio that had no volatility management or capital protection.
But also you might have cash that you've accumulated that you could live off that for during that period until the markets recover and then you start drawing. So there's that
There's
aspect.
way to structure
there's from financial planning, there's lots we can do to help as well. And another problem is that, or could be a problem, is if all your living annuities pension is put into offshore.
So that's exactly.
And the offshore is linked to the rand volatility, and the rand drops or gets better in value, and then you're subject to that, and that can be huge.
And that's a question we get asked very often. Shouldn't we just have 100% offshore in my living annuity because I've got the flexibility, I'm not restricted? The reality is, in your living annuity, you do need to err on the side of caution. For the average investor drawing their 6% per annum, there's a concept called asset and liability matching, which means you have to have sufficient assets in your local currency to cover your local expenses. So you are drawing your 6%, you need to make sure that that income that you get is sufficient enough to cover your living expenses. The problem with having 100% exposed to offshore markets in a living annuity is that, yes, it's dollar assets, but it's denominated in rands. And so you're exposing yourself to currency fluctuations.
Yeah.
And the rand is one of the most volatile currencies in the world. So again, if you have 100% exposed to offshore and it's all exposed to currency and the rand strengthens, for example, and it is possible that the rand can have extreme strength in 1 year and the rand strengthens, say, 15 to 20%, and you're now drawing your 6%, it's almost equivalent to markets falling to that extent because your capital is worth that 15 to 20% less.
You can't have 100% equity as well. You've got to have some defensive assets in that portfolio.
Because you're trying to manage the sequence of returns risk.
Correct.
So I think in the post-retirement context, you have to have a more balanced and prudent approach to how you construct these portfolios. Because in as much as equities over long periods of time give you your best chance at beating inflation and ensure sustainability of your capital, you can't have too much of it, because when you are drawing an income and relying on that income, you need to manage the volatility of that portfolio.
I think how you can explain it is we have our model portfolios with Fund House, so we have our balanced portfolio, which is for the clients that are trying to accumulate the money for retirement. So if you kind of have a look at those returns, it's a lot more volatile. It's up and down because you're trying to grow now. So your period is 10 to 20 years. Once our clients then are in post-retirement, we have a balanced income fund, which is where you're going to be drawing an income from that. So if you put the two fund fact sheets next to each other, this one's doing really well because it's less volatile than this one, but you almost don't want this one to do...
You don't want it to be volatile.
Yeah.
Yes, you want that one to be volatile. You don't want this one to be volatile. So you have to just match it and move your money depending on where you're at and what you're doing with it.
Absolutely, and that's why there's different mandates with funds. So even at Coronation, we have our balance fund, which is a pre-retirement savings vehicle. But once you get to retirement, we'd suggest you'd use a different fund, like Capital Plus, which is designed and structured in a slightly different way to cater for that income drawdown, plus that need to deliver inflation plus 4%. Because there are different mandates, so that's why you have different model portfolios with different mandates to cater for different needs in your financial planning journey.
I wonder one thing. It's as time has gone on and there are more things you can spend your money on now, how does that concept apply to how you look at saving for retirement? Because again, if we go back into like earlier generations, there weren't so many things that we have today. I mean, my son is a great example. When I was a little boy versus me having a little boy now, I talk to my mom about it all the time. All the crap we can buy for him, it's ridiculous. The mother's group fees that you pay to go and be part of a group. Then you've got his swimming lessons. Then you've got this. Then you've got that. So there's just lots more stuff you're expected to pay for now. But
Warren, that's where the fund managers are. They fortunate in a way, because years ago Naspers wasn't a share to consider. And Naspers owns a big chunk of a company in China called Tencent. And Tencent they do a platform almost like Facebook. And a lot of the kids in China that's their platform on Facebook. When I was little, we didn't even have computers, never mind Facebook. But you had other things like commodities, like gold was a very big mining, gold mines. And the fund manager used to buy the gold mines. Now they're buying like Apple and all those kind of, they didn't have cell phones in those days. And you didn't, and now the platforms, you've got these computer gaming scenarios that are just in the sky. So that's where the fund managers spend their life going to find new frontiers to invest for our clients' money. Yeah.
Look, more choice is not necessarily a bad thing. It can be overwhelming when you have more choice. But I think from a fund management perspective, more choice means more opportunities.
Amazing.
You just have to have the skills and
identify
the ability
right ones,
to cover those ideas and opportunities and implement them in a framework that also caters for risk and
money's got to be safe, all those kind of things.
Exactly. But I don't think choice is necessarily a bad thing.
No, I just think of it like, you say earlier in the other podcast we did, you mentioned how things were not static and they were dynamic. Projecting into the future is a hard thing to do, isn't it?
It is. I always say if it was easy, everybody would do it.
Exactly. That's why.
And there's forecast risk, and that's the risk that your assumptions are not going to play out the way you want to. But I think the best fund managers in the world get more right than they get wrong. It's not that they get nothing wrong.
No. Understood. And as technology improves, I know everyone likes to talk about AI now, but as that technology is moving forward at such a rapid pace, does it play more of an integral role in research and developing your ideas?
It hasn't played that role for us necessarily. We haven't gotten to that point where we are replacing the human element of research with
not replacing,
but it does assist. We have started to use it to take notes, to summarize long documents, and to create efficiencies in how we do things. But I think given that our proprietary research is it's the cornerstone of our investment process, a machine or AI cannot replace that gut feel you get when you speak to a company CEO or you speak to industry participants and get a sense of what is going on with a particular sector and industry. So I don't think we would ever get to a point where it replaces, but there's obvious
but as far as
efficiencies that are created through AI.
Data-driven research and stuff like that, it's a lot easier to do it.
Yeah, look, it depends on your investment process, right? There are portfolios out there that are more what they call quants-driven, which will rely on big data and processing large amounts of data to come up with ideas and filter ideas. It's
very mathematical.
We have a different fundamental approach to how we go about
the human
stock selection.
Yeah.
Awesome. Thank you so
Mika,
much.
once again,
It's a pleasure.
Thank
Thanks,
you so
guys.
much.
Thanks for having me.
Thanks, guys.
Thank you.
Bye.
Thank you for listening. If you have enjoyed this podcast or would like to subscribe, please visit our website, www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.